Gold just climbed 0.5% to $5,049 per ounce. Silver surged 2.2% to $82.43. And here's what nobody is telling you. This bounce is happening while everyone else is still panicking from Goldie's 600 crash 2 weeks ago. The data that just dropped on us, retail sales, it revealed something that could decide whether you make money or lose money in the next 60 days. Welcome to Capital Anchor. I'm here to show you what's actually happening in markets while the mainstream keeps you distracted. If this is your first time here, hit subscribe right now because what I am about to break down could completely change how you think about precious metals in 2026. Here's what happened this morning, February 11, 2026. US Treasury yields fell after retail sales data came in flat for December. Zero growth. Households stopped buying cars and big-ticket items. Markets immediately priced this as weakness. Gold responded instantly up 0.5%. Silver jumped more than 2%. But here's the part that matters. Gold is now trading at $5,049, which means it is still down $600 from its all-time high of $5,594 hit on January 28. That is a 10.7% correction in just 2 weeks. Most people see a correction and think it's over. What they're missing is the mechanism underneath. Think of gold like a pressure valve on a water system. When economic data shows weakness like retail sales stalling, that pressure builds. Lower yields mean the cost of holding gold just dropped, the dollar weakens. And suddenly, that non-yielding yellow metal becomes the logical place for capital to flow. This morning's move wasn't random. It was mechanical. The retail sales number revealed something deeper. Americans scaled back on motor vehicles and other major purchases. This isn't just 1 month of caution. This is consumer behavior shifting, and when consumer spending, which represents 70% of the U.S. economy, starts pulling back, the Federal Reserve's entire calculus changes. Markets are now pricing in at least 225 basis point rate cuts in 2026, the first one expected in June. Let me give you 3 reasons why this retail sales data matters more than you think. Reason number 1, it confirms what central banks already know but won't say publicly. The economy is softening faster than official narratives admit. December retail sales were supposed to capture holiday spending momentum. They came in at 0. Not down, but zero growth is a warning signal. When households stop spending on cars and big purchases, it means either they're tapped out or they're getting nervous. Either way, that's deflationary pressure building in the real economy. Reason number 2, falling yields change the entire equation for gold. Here's what most retail investors don't understand. Gold doesn't pay interest. It just sits there. So when Treasury yields are high, investors face an opportunity cost. They are giving up guaranteed income to hold a metal that pays nothing. But when yields fall, that cost disappears. And today, yields dropped because the market looked at stalled retail sales and thought, the Fed is going to cut rates sooner than we expected. Lower yields mean lower opportunity cost. That's why gold bounced. Reason number 3. This is happening while gold is still $600 below its record high. Think about the timing. 2 weeks ago, gold hit $5,594 on January 28. Then it crashed hard. Now here's the disconnect everyone is missing. While you were being told that gold crashed because Kevin Warsh got nominated as the next Fed chair, which is true, by the way, that announcement triggered the sell-off. What nobody explained is what the big players were actually doing. Let's break it down. The mainstream narrative on January 30th was simple. Warsh is a hawk. He'll keep rates higher for longer. Gold doesn't like high rates. Sell. That's what retail did. They panicked and sold into the crash. But here's what was happening behind the scenes. Central banks bought 863 tons of gold in 2025. That's below the 1,000 ton plus levels of the previous 3 years, but it's still nearly double the pre-2022 average of 473 tons. The National Bank of Poland added 102 tons in 2025 alone. That's not speculation. That's strategic accumulation. And they didn't stop buying just because gold hit $5,500. In fact, central bank buying accelerated in Q for 2025, reaching 230 tons in the final quarter. Why does this matter? Because central banks don't trade, they allocate. They're not trying to flip gold for a 10% gain. They're diversifying reserves away from dollar-denominated assets, and that trend, de-dollarization, is structural. It doesn't stop because of a pullback in price. If anything, price dips accelerate their buying. Now look at what happened in India. In January 2026, Indian investors piled into gold exchange-traded funds at a pace that surpassed equity fund inflows. Read that again. In the world's second-largest gold-consuming nation, demand for gold ETFs exceeded demand for stocks. That's not panic. That's a fundamental shift in how people perceive risk. Meanwhile, J.P. Morgan raised its 2026 gold price forecast to an average of $5,055 per ounce by Q4, with a path to $6,000 in a diversification scenario. But retail? Retail sold on January 30th. They saw the crash and thought it was over. They sold at $5,000, maybe lower. And now, 2 weeks later, gold is back at $5,049, bouncing on weak retail sales data, and they're sitting on the sidelines asking, should I buy back in? Here's what was really happening while you were being told to panic. Institutions were using the crash as an entry point. Think about it. Gold rallied 24% in January alone. That's the biggest monthly gain since the 1980s. Every leveraged position, every momentum trade, every retail FOMO buyer who jumped in at $5,400 or $5,500, they all got flushed out in one violent session. And that created the exact opportunity that patient capital was waiting for. This is how markets transfer wealth, from the impatient to the prepared, from the emotional to the strategic. While retail investors were selling because the price went down, central banks were buying because the fundamentals hadn't changed. That's the game. Silver tells the same story, just with more violence. Silver hit $120.45 per ounce on January 28th, an all-time record. Then it crashed 17% in a single session, falling to $95. By February 3rd, it had dropped as much as 30% from its peak. And today? It's at $82.43, up 2.2%, still down 31% from the high, but bouncing. The silver market is smaller than gold. That makes it more volatile. But it also makes it more explosive. Industrial demand for silver is surging. Every solar panel uses 20 grams of silver. The solar industry alone consumes nearly 30% of total global silver demand. Electric vehicles use 25-50 grams each. AI data centers need silver for semiconductors. This isn't speculative demand. This is structural consumption, and it's not being recovered. Unlike gold, which gets recycled, most industrial silver is gone forever. The Silver Institute reported that the market has been in deficit for 5 consecutive years. That means global consumption exceeds mine supply. And mine supply is inelastic because 70% of silver is mined as a byproduct of copper, lead, or zinc. So even if silver prices double, production doesn't respond immediately. That's a supply crisis building in real time. Let me show you what happened the last time gold had a violent correction after hitting all-time highs, and what came next. August 2020, gold hit $20.75 per ounce after a parabolic rally driven by COVID stimulus and zero interest rates. Then it crashed 8% in 3 days. Retail investors panicked. They sold. The narrative was simple. The top is in. Gold is done. The pattern is always the same. Gold rallies on fundamental drivers: currency debasement, geopolitical tension, central bank buying. Then it corrects violently when leveraged positions unwind or a narrative shift spooks retail. But the fundamentals don't disappear. They compound. And 6 months later, 12 months later, gold is higher than before. Right now, on February 11, 2026, we're in that correction phase. First, central bank demand. I already told you 863 tons purchased in 2025. The National Bank of Poland added 102 tons. Central banks accumulated 230 tons in Q4 alone. That buying didn't stop because Kevin Warsh got nominated. Central banks allocate over quarters and years, not days. The structural trend toward reserve diversification and de-dollarization is intact. China, Russia, India, Turkey, they're not reversing course because of a 2-week pullback. Second, the Federal Reserve's trajectory. Markets are now pricing to rate cuts in 2026, the first expected in June. Why? Because economic data is softening. Retail sales came in at zero growth in December. The labor market is cooling. Inflation is trending toward the Fed's 2% target. Jerome Powell and the FOMC have signaled they're closer to cutting than hiking. And when rates fall, gold rallies every single time. Third, supply fundamentals in silver. The Silver Institute confirmed 5 consecutive years of deficits. Industrial demand is surging: solar panels, electric vehicles, AI infrastructure. But mine supply is stuck because 70% of silver is a byproduct. Miners don't just dig for silver. They dig for copper or zinc, and silver comes along for the ride. So even at $82 per ounce, production won't surge overnight. The deficit persists. Fourth, institutional positioning. J.P. Morgan, Wells Fargo, Deutsche Bank all raised their 2026 gold targets. J.P. Morgan sees $5,055 by Q4 with a path to $6,000. Wells Fargo targets 6100-6300. These are not small revisions. These are major institutions telling their clients, allocate to gold. And when institutions allocate, they move billions. That capital is patient. It doesn't panic on a 2-week correction. So here's my prediction, on the record. Screenshot this. Gold will reclaim $5,500 per ounce by June 2026, and it will hit $6,000 by December 2026. Why? Because the 2 catalysts that drove gold to $5,594 in January are still in play: falling real yields and central bank buying. Add a Federal Reserve that's about to start cutting rates, and you have the perfect setup for the next leg higher. The correction we just saw was the shakeout. The bounce we're seeing today is the beginning of the recovery, and the rally that comes next will leave retail investors, the ones who sold at $5,000, on the sidelines watching. Now let me give you the scenarios with probabilities. Scenario 1, gold consolidates between $4,900 and $5,200 through March, then breaks higher in Q2 as the Fed signals rate cuts. Scenario 2, gold retests $4,800 or even $4,700 on another wave of profit-taking, or if Kevin Warsh makes hawkish comments before his confirmation. But the dip gets bought aggressively by institutions and central banks. Recovery begins in Q3. Year-end target still 58006000. Probability 25%. This is the deeper correction first scenario. It's painful for anyone holding right now, but the outcome is the same: higher prices by year-end. Scenario 3. Something breaks. A major financial institution fails. A sovereign debt crisis erupts, geopolitical escalation in the Middle East or between the US and China. Gold spikes to $6,500 or higher within 90 days as safe haven demand explodes. Probability 15%. This is the black swan scenario, low probability, but high impact. And if it happens, gold doesn't just rally, it goes parabolic. Now let me break down what you should actually do based on where you are right now. If you're holding physical gold or silver, do nothing. You bought insurance, not a trading position. The fundamentals are intact. Central banks are buying. The Fed is about to cut rates. Supply deficits in silver are real. Your position is a long-term allocation. Ignore the noise. If anything, use this correction to add more dollar cost average, buy incrementally, but do not sell into weakness. If you're trading gold or silver with leverage, you need to manage risk differently. Leverage amplifies both gains and losses. If you bought gold at $5,400 or silver at $110, you're underwater. Here's the reality: you either average down carefully with strict stop losses, or you cut the position and wait for a clearer entry. Leveraged trades require technical discipline. Watch the $5,100 level on gold and $85 on silver. If those break, we could see another leg down. If they hold, the bounce continues. If you're sitting on cash waiting to buy, you're in the best position. Use this correction. Don't try to time the exact bottom, you'll miss it. Instead, build a position over the next 30 days, buy 25% now at $5,049 gold. If you bought at the top and you're panicking, stop, take a breath. You made a mistake, you chased momentum. But the mistake isn't fatal if you understand what you actually bought. Did you buy gold because you thought it would go up forever? Or did you buy it because you understand the macro thesis? If it's the first, you're going to sell at the worst time. If it's the second, you hold and possibly add. The macro thesis, central bank buying, de-dollarization, falling real yields, is still valid. Here's what you need to watch going forward. First, The DXY, the US dollar index, gold and the dollar move inversely. If the DXY breaks below 107, gold rallies. If it breaks above 110, gold faces headwinds. Right now, the DXY is around 108. Watch that level. Second, 10-year Treasury yields. Gold moved today because yields fell on weak retail sales data. If yields continue falling toward 4.2% or lower, gold has room to run. If yields spike back above 4.6%, gold struggles. Third, central bank purchase reports. The World Gold Council releases monthly data. Watch for any acceleration in buying from China, Russia, India, or Poland. If central banks increase their pace, that's a bullish signal. Fourth, COMEX gold and silver inventory levels. When inventories drop, it signals physical demand is tightening. Check the CME Group's daily reports. If registered inventories fall below critical thresholds, that's a supply squeeze building. Now let me tell you about the 3 types of people watching this video right now. The first type is panicking. They bought gold at $5,400 or silver at $110. They're down 10%, 20%, maybe more. They're checking the price every hour. They're reading headlines that say gold crash and silver collapse. They're thinking about selling, and if they do, they'll lock in their losses right before the recovery begins. The second type is frozen. They want to buy. They know the fundamentals make sense, but they're scared. What if it drops more? What if they buy today and it's $4,800 next week? So they wait, and they keep waiting, and 6 months from now, when gold is at $5,800, they'll still be waiting for the perfect entry that never comes. The third type is learning and preparing. They understand that markets don't move in straight lines. They know that corrections are normal, even healthy. They see a 10% pullback from all-time highs as an opportunity, not a disaster. They're not panicking. They're not frozen. They're calculating. They're positioning. And they'll be the ones who profit when everyone else is chasing the next rally. Which type are you? Here's what you need to understand about wealth transfer in markets. It doesn't happen when everyone agrees. It happens in moments like this, when prices are falling, when narratives are negative, when retail is selling and institutions are quietly buying. Wealth moves from the impatient to the patient, from the emotional to the strategic. From those who react to headlines to those who understand mechanisms. Gold just climbed because us retail sales stalled and yields fell. That's the mechanism I showed you at the start. The pressure valve. Weak economic data builds the case for rate cuts. Rate cuts lower the opportunity cost of holding gold. And gold rallies. This morning's move wasn't random. It was predictable if you understood the system. If you found value in this breakdown, hit the like button right now. Subscribe to Capital Anchor if you want to see what is actually happening in markets while everyone else stays distracted. And share this video with someone who is holding gold or silver right now and doesn't know whether to panic or hold. They need to see this. Drop one word in the comments. Hold if you're staying in your position, or buy if you're using this correction to add more. I want to see where everyone's head is at. The move is already starting. Don't be the one who figures it out 6 months too late.